I would like to welcome you to the workshop series titled Handling Money God's Way. The presenter, Tom Copland, is a servant of the Lord Jesus Christ who has been called to teach God's Word on finances since 1982. Tom has helped thousands of people learn and apply God's financial principles. Tom is the founder and president of Copland Financial Ministries, and his financial moments are aired on numerous radio and TV stations. Now, here's Tom teaching Handling Money God's Way.
I would like to welcome you to part 2 of session 4 of the Handling Money God's Way series. In the parable of the tower, Luke 14:28-30, Christ admonished us to plan ahead, and the most practical way to do that is to develop and implement a budget. In this part, I will be demonstrating in detail how to use the Copland budgeting system. There are actually 8 parts to this video. They're joined together, of course, and you'll see in these 8 different parts, the first is providing an overview of the Copland budgeting system, and then the next 7 deal with each form, namely form number 1, number 2, number 3, number 4, number 5, number 6, and number 7, all of the Copland budgeting system. To obtain a free copy of the Excel-based Copland budgeting system or to review the video again, go to our website, which is coplandfinancialministries.org. I'd like to demonstrate the Copland budgeting system. The system consists of 7 forms, and I'm going to give you a quick overview of each form and how they work, and then come back and provide the details. Form number 1 provides a list of simply your assets and liabilities. Form number 2 is where you indicate what your salaries, wages, and other income is, and you put your salaries and wages net of your taxes. Form number 3 is the non-monthly expense planning form, where you key in the annual costs and then it's automatically calculated on a monthly basis. You need to keep track of these so you can provide for them. Form number 4 is a savings account allocation, so that when you do set aside money for savings, if it's designated for a future expense, you'll know what it's there for. Form number 5 is your estimated monthly budget, which provides an overview of all of the expenses that you anticipate you're going to be incur on a monthly basis. This is an important form as it shows, perhaps more importantly than anything else, whether you have a monthly surplus or deficit. Form number 6 is the form that you're going to use almost on a daily or perhaps every 2 or 3 days, where you start tracking your expenditures, and I'll provide the details later, but it's an important form. Form number 7 is one where you don't actually have to put anything on. It's automatically calculated. The figures from your present budget from form number 5 end up in the first column, and the figures in terms of your actual expenses for a month from form number 6 end up in the second column, and then it actually compares your actual expenses to your budgeted amounts, and it shows where you're over budget or under budget. Here's my detailed explanation of form number 1. On this form, what's critical is to list the assets and liabilities. As the proverb says, know well the condition of your herds and flocks and grains. We don't have herds and flocks and grains today because we're not, most of us at least, aren't farmers. But we do need to know well, we need to understand what our different assets and liabilities are. So I'm going to put in some sample numbers. So for this couple, I'm going to assume that they have $1,000 in the bank. I'm also going to assume that they have investments, perhaps in a mutual fund or something, of $10,000. In terms of their principal residence, they estimate that the fair market value of their principal residence is $350,000. In terms of their pension plan, their RSPs, the husband has about $40,000 in his, and the wife has about $10,000 in hers. We now go to the liability side. And by the way, you should list any other assets. This is sort of for those other types of assets that could be sold and generated some cash. Do not list anything of a personal nature that you would never ever sell or couldn't be sold. But often if people go and look at their basement, they could have stuff in their basement, things that are valuable to other people that they could sell through a garage sale or through the internet or whatever, and you would list those there. And if you do have something, let's suppose this couple does go into their basement and they figure out they have $5,000 worth, so we're going to put that in there. Next, we'd like to list their liabilities. And the first line is their credit cards, and this couple are doing what most people are doing. They're running up their credit cards, and they owe $25,000. In terms of personal loans, they have loans that they owe to family members of $30,000. In terms of some of their other debts, they have a personal line of credit on their home of $60,000. They've done what a lot of people do. They've basically done some bill consolidation loans where they've taken out a personal line of credit in order to pay down their credit cards. Because if they look at their finances over the last couple of years, they've been spending a little more than they've been making on a regular basis, which is so common. In terms of the mortgage on their principal residence, we're going to assume that that's $200,000. And you can see the total here. By the way, you should watch for other types of debts. For example, there could be things like property taxes overdue. There could be things like dental bills or any other types. And we're going to assume that they have $10,000 of some of those other costs. So you can see the total liabilities that this couple has is $325,000. And their net worth on their personal balance sheet here is $91,000, which on the surface looks not too bad. But in actual fact, when we get into some of the other forms, you'll see that they have been spending more than they're making on a monthly basis, and that's why they're running up the credit cards, and that's why they have the personal loans and the personal line of credit. On form number 2, you essentially list the revenues or the income that you have for a typical month. So let's suppose that the husband's wages, a net of his withholdings, again, put in net of with his holdings, is $4,000 a month. And let's suppose that the wife works part-time. She earns $1,000 a month. And let's suppose they have a little bit of investment income, maybe $100 a month. And then they have other miscellaneous income, can be like a child tax benefit or something like that of $200 a month. So I think you can see this form is very simple, very straightforward. You just list all the sources of income on a monthly basis. And as you can see, we've got formulas in this Excel template that total up the total revenue for a month. And you'll see at a later date that this total revenue does show up on form number 5. And also please note that it's important to, I would round everything to the nearest dollar. You don't need to put in pennies. It'll make it a whole lot faster. Form number 3 is the non-monthly expense planning. This form is really important. Often when individuals or couples prepare their own budget, they will forget about their non-monthly expenses. And you can see some sample non-monthly expenses here. You'll notice that it's important to key in an estimate for the year. Wherever the yellow shading is, you should key that in. For example, house maintenance. This couple is estimating based on prior years that their house maintenance for a typical year would be $1,200 a year. And as you can see, it automatically does the calculation and it shows up as $100 a month. Property taxes, they know that last year their property taxes was $3,300, so they're going to key that number in. And again, you can see that works out to a cost of $275 a month. Now, by the way, if your property taxes is included in the payment of your mortgage on a monthly basis, you don't have to put anything there. House insurance, normally it's paid once a year, and last year it was about $600, so that's their estimate. Automobile replacement, it is important to save for your next automobile. This couple is not going to put any money in there because they don't have it. They are running a deficit on a monthly basis, but they should ideally, once they get their monthly cash flow under control, be setting aside some funds on a monthly basis for their next automobile. Automobile repairs and maintenance. This couple estimates, based on prior years, they have 2 cars, $2,400 a year. Some people will say to me, and as you can see that works out to $200 a month, that they need to set aside for auto repairs. Some will say, well, we don't know what that's going to be, and that's true. But if you, just a rule of thumb, if you allow about $1,200 per year per car, you'll probably cover off most of your automobile repairs. There will be exceptions, but you'll probably cover off most of them. And even if you ran over that, at least you would have some money available. Auto insurance, it's anticipated their auto insurance next year will be about $2,000. So they key that in, and again, it calculates $167 a month. Vacation, this couple plans to take a vacation next year, and they estimate the cost of that will be $1,800 for next year. And by doing this, by saving $150 a month, when it comes to next year's vacation, they'll have the cash available. and they won't do what most people do, that is put it on the credit card and get into debt. Investments for their pension plan, they should be putting aside some money for that on a monthly basis. This couple's not doing that because they are in debt and they do have a negative monthly cash flow, but once they get their finances in order, they should do that. Healthcare expenses, they estimate it could run $1,500 a year based on prior years. Again, it's only an estimate. If you have children that need braces or something, that obviously is going to be a lot more, but they're going to put through the $1,500 a year. Christmas gifts, they estimate that they're going to spend about $900 on Christmas and birthdays in an average year, and they key that number in, it works out to $75 a month. Other is the miscellaneous category that doesn't cover anything else, and often people will say to me, well, $50, $100 a month. Not true. Often $3,600 a year or $300 a month would be quite typical for the average couple. What's important about this form is that you can see the non-monthly expenses add up to a total here of $1,442 a month, and that means every month they need to set aside that money to save for these expenses so that when these expenses come due, they have the cash and they're not forced into debt. As you can see, you should prepare this form initially and revise it only when there are changes in future. So this is not a form that you have to do every month. This is form number 4, the savings account allocations. The purpose of this form is that when you do save a certain amount each month for the various categories, it automatically allocates the amounts over here across the top to each category. And the whole purpose, by the way, is so that if you have money in your savings account, you can determine how much money is designated for future needs and how much would be surplus funds. And so here's how it works. If you go to form number 3 for a minute, you'll see on form number 3 that we calculated certain non-monthly expenses. For example, house maintenance was $1,200 per year, and it works out to about $100 per month. Or property taxes works out to $275 per month. If we go to form number 4, you'll see that these amounts automatically show up here. And as a matter of fact, if you follow it through, all of the other amounts that are calculated on form number 3, these amounts that are showing in this column here, right down to the $300 for others, they're showing over here on form number 4. And the idea here is, again, to know how much money you need to have in your savings account for future expenses. Now, one of the practical aspects is, of course, you can have all these allocations on an accounting basis in your savings account, but you got to actually put some money there. So what you do there is you go to form number 6, and in form number 6, you have to record the revenue. Now, we're going to assume that this couple gets their revenue once a month. If it's twice a month or 4 times a month for you, you would key it in independently. But I'm assuming once a month they get their full $5,300. And then what they would do immediately is they would transfer $1,442. That was the total amount at the bottom of form number 3. They would transfer that to their savings account to cover the non-monthly expenses. And you can see I keyed the $1,442 in there. So if you go back to form number 4, you will see the $1,442 shows up as a receipt from the checking account. There it is. And you can see that we actually have a balance in the account of $1,442. Now, the main purpose of this form is what's shown at the bottom here. We have funds in the savings account of $1,442, designated funds for future expenses of $1,442. So that means the undesignated funds is zero in this case. What that does is it prevents the couple. Often I see couples or individuals will say, hey, can we afford that new TV that's $1,000? And they'll say, well, sure we can. We have $1,442 in our savings account, when in fact they cannot afford to buy it because those funds in their savings account are designated for future expenses. And since they have no funds available, they have no undesignated funds, they should not go out and make that expenditures. All their savings effectively is accounted for. It's designated for future purposes. And that's the main purpose of keeping track of form number 4 and all these various expenses in your savings account. This is form number 5, which is the estimated monthly budget. This is the form that sort of ties a lot of things together, shows you your expenses, including the different types of expenses, and you'll see we'll come down and we'll determine if there's a monthly surplus or a deficit. For this particular couple, they're giving about $100 a month to the Lord's work. Their mortgage of $1,013 is what they pay on a monthly basis. Their electricity bill is averaging about $275 per month. Their gas bill is $225 per month on average. Their water and sewage is about $100 per month. Their telephone is about $300 per month. Now this includes other things like internet connection as well as cable TV and that kind of stuff. Now you'll notice what I'm doing here is filling in those boxes that are yellow. There's some numbers that are here already, and these figures came from form number 3. For example, the property taxes of $275, that was calculated over here on form number 3, and it automatically gets transferred to form number 5. And you'll see there's other numbers here that I did not have to put in that came from form number 3 as well. The maintenance of $100, the insurance of $50, the insurance on the automobile $167, car maintenance, etc., and several others on this side, vacation, as well as health care, gifts, and others. So those automatically flip over from form number 3 into form number 5. But there are some expenses, and these are the ones, again, that are marked with yellow. Some of those categories have to be filled in. And by the way, if you don't have the exact number, don't worry, at least give it your best estimate, perhaps allow a bit of a cushion. For this couple, they looked at their food bills over the last several months, and they have two teenage boys, so they're spending more than normal, $800 a month. Automobile replacement, that was calculated on Form 3. Remember, they should be saving for their next automobile, but they're not doing that. Gas and oil, they do have 2 cars, and right now they're spending about $300 per month. On their credit cards, they're only paying the minimum payment each month, which is not good, but that's all they're doing. That's $500 per month. And on their personal line of credit, they're just paying interest, and that works out to about $210 per month. If you now go up to the other side, eating out, they spend on average $250 per month. Their vacations $150 per month. That comes from our calculation on form number 3 of $1,800 divided by 12. Their sports, gym, that kind of stuff, they spend about $100 per month. On clothing, they're incurring about $200 per month. And insurance, these are things like life and disability insurance. That's being taken out of their bank account on a monthly basis. It's about $100 per month. And for education for their children, just miscellaneous education costs, books, etc., they spend about $100 per month. So what you can see this form is, once you completed everything here, you can see their total expenses for a typical month is $6,015, while their total revenues, which comes from form number 2, is only $5,300. So if they did include all of their non-monthly expenses that we've included, they end up with a monthly deficit of $715 a month. And this is very typical of what we see with most individuals and couples. That is, they're spending a little more than they're making, typically using credit cards or personal lines of credit in order to finance it, and as a result they're accumulating debt and they're incurring a monthly deficit. And this is one of the first things that they have to deal with. And often what I'll suggest at this point to whoever we're working with, that they go through some of these expense categories and decide together what expenses they could lower in order to try to balance this somehow. They have to make sure that they're spending less than they're earning, so they have a surplus here, so they have some money available on a monthly basis to pay down debt rather than spending more than they're making and accumulating debt. This is form number 6. This is the form that allows you to track your expenditures by the various categories on a regular basis. And I usually recommend to individuals that they update this form every day or perhaps every 3 or 4 days and keep track of it. I also usually suggest that if you're married, to have one checking account and one savings account, have one joint checking account, and have all your expenditures go through this one joint checking account. And if you do use a credit card, pay them off each month, and as you pay them, record the expenses to the various expenses as shown here. So I'm going to just give a few examples in terms of the figures. Let's suppose the first thing they do is they pay their mortgage payment for the month, which is $1,013, and let's suppose they give $100 to the Lord's work, and then let's suppose they incur some expenses for food, and let's suppose it's $400, And let's suppose they now come up with an automobile repair, and it's $100. They pay that, and you can see as they disperse these expenses, and you should put them in according to the day. You can see the day each here. As they disperse these expenses, the balance automatically decreases over here. So this way you can keep track of how much money is in your joint checking account, so you don't spend more than you have there. For those expenses, for example, automobile repair, where we do have some funds in the savings account, you certainly should pay it from your checking account, but you can actually transfer money from your savings account to your checking account to cover this. And so to do that, you basically go to form number 4. And in form number 4, you'll see under automobile repairs, we do have $200 there. And so what you do is you key in a minus $100, and what that does there is it takes $100 out of this category, and you can see it automatically transfers that $100 over to the checking account. And by the way, don't forget to physically transfer the funds as well, either through the internet or ask the bank to transfer it when you're at the bank next time. But you see this $100 automatically comes here, and it increases and it now is available for the automobile expense to cover that $100. Next, this couple on the 8th day of the month, they had to make the payment on their personal line of credit, and sorry, I meant on their credit card, and that was $500. And they made it on that day, and we've recorded that payment. They've also incurred on the following day entertainment and recreation expense of $150, and they also incurred some clothing expense of, let's say, $200. And basically what you do is you enter into the various types of expenses as they're incurred throughout the month. On the next day, they incurred some house expense. It was actually a house repair of $125. And again, if you recall, house repairs, we do have some money in the savings account that can cover that. So let's go over to the savings account form number 4. And if we look under house maintenance, we do have $100. We don't have the full $125, but we do have $100. And so we can transfer that $100 from the savings account over to the checking account. And again, be sure to transfer it physically as well. Don't just transfer it on your form, but transfer the money physically between the bank accounts. And you can see as we do transfer this money, the balance in your savings account calculated here automatically gets reduced, and you'll see that $100 shows up on the 10th day of the month over on form number 6, and here it is there in order to cover this expense of $125. Now in that case, we didn't have the full amount available in the savings account, but at least we could cover the majority of that expense, and we only had to take effectively $25 out of our joint checking account. And this couple just continues to record their expenses as they're incurred. Let's suppose for house expense, on the next day they pay their hydro bill of $250, and a couple days later they pay their gas bill of $225, and then their water bill comes in and they pay $120 on that one. And then let's suppose after that their property tax bill comes in, and it's $550. Now again, if you remember, part of this property tax bill was covered and is available in form number 3 in the savings account. My apologies, it's form number 4 in the savings account. And because we do have some money available there, at least $275 worth on the property taxes, we can take those funds from an accounting perspective from the savings account and transfer it to the checking account. Again, remember to do that physically. And you do that by just simply entering a minus $275 there. And you can see the savings account balance comes down. You can also see that the designated funds get adjusted as well. We had $275 that we put in there at the beginning of the month, designated for property taxes. We've taken it out so there's nothing left. And again, you look down here, they have $967 in the savings account, and the full amount of the funds are designated for future purposes. So again, they still have no undesignated funds. So this couple should never think because they have money in their savings account that they can go spend some. All these funds are designated for future needs. So we'll go back now to form number 6, and this couple just continues to incur other expenses. Let's suppose on the automobile side they incur their gasoline bill, and they paid that of $300, and that they've incurred some other expenses, some more entertainment and recreation, perhaps $125, and then they've incurred some healthcare expenses, perhaps some chiropractic bills or something of that nature of $150. Their life insurance premium comes due, and they have to pay that. It's $100 a month. And miscellaneous, let's suppose they incur all their miscellaneous expense of $330 at one time in the month. Obviously, for most cases, they're going to incur that over several times in the month. And that's what form number 6 does. What it effectively does is it tracks your expenditures throughout the month. And often a couple or an individual have to do this, prepare this form for 3 or 4 or 5, 6 months to get a really good handle on where their money's going. And by the way, just tracking your expenditures can make you more conscientious of where you spend money. And often we find that the income, the spending rather, goes down. Now you'll see in this case we did keep track of the balance here, so they actually ran into an overdraft, and obviously the only way they're going to be able to fund that is if they have an overdraft privilege or a line of credit. I've assumed that they have that here. Again, it's not an ideal, but at least they have it. So what we have here, that's the end of form number 6. The idea is to track your expenditures. It is best to update this form every 2 or 3 days, and if you have to do some estimates sometimes. Perhaps you took $100 out of the bank and you have $20 left in your wallet and you're not sure where the money went. At least allocate it to somewhere. Often people will allocate it into the miscellaneous categories. If you can track your expenditures within $100 per month, if you can track within $100 of what you're spending, you're doing much better than most. Form number 7 is the budget analysis form. On this form, you actually don't need to enter anything. All this does is it takes your present budget on form number 5 and your actual expenditures on form number 6, and it compares the two and lets you know whether you're over or under budget. Now, with this couple's particular situation, they are spending more than they're earning, even on their budget, so they obviously at some point have to go back and go through form number 5 and reduce some of their expenditures. But as you can see, their actual expenditures, as they're compared to their budgeted expenditures, it just shows you the overage and underages, and it just lets you know if you're spending more than your budget in a certain category, and sort of highlights it for you to deal with that.
If you would like to learn more about handling money God's way, be sure to check out the numerous resources available at CoplandFinancialMinistries.org. Again, CoplandFinancialMinistries.org.